Next speaker, Anton. Govor is from the Moscow Exchange. The exchange is the fundamental support of everything we do in financial markets. And Anton is head of strategy. So what's the exchange going to do to help us out of this problem?
I'll try to answer this question in the microphone. No. Okay, good evening, ladies and gentlemen. I'll try. Oops, it doesn't work. So I'll try to answer it to the extent possible. Just basically, it's kind of probably not standard presentation you can expect in this kind of event. Not going to talk specifically about any kind of forecasts. But what I wanted to talk today about is how the infrastructure globally changed and what it means to the market and to the stocks you are forecasting. So actually the whole industry of the on-exchange trading is going under tremendous change. There is a tremendous change going globally. So the first thing I would start to is the competition. So effectively you have major financial centers which are obvious. There is one in US, there is one in Europe, there is one in Asia. And all of them are trying to do one thing, they're trying to concentrate liquidity. So effectively, if you look in 10 to 20 years, I would say there is likely to be, I mean, now we have like 100 exchanges globally. I expect this number to decrease significantly. And that's for a very simple reason, because the competition in trading is global, and global competition drives the cost of the infrastructure down. If you have a larger pool of liquidity, your cost of trade decreases per each trade because the cost of infrastructure is fixed. So that's what is going to drive this industry. There are two different strategies which are currently used by major players. One is, who knows who BATS is? BATS, Chi-X, Direct Edge. Who knows these names? Okay, very simple story for you to understand what is the aggressive competition in the exchange industry. You probably know the New York Stock Exchange and NASDAQ, like the two most powerful exchanges in the US. Well, actually now there are three. The BATS is the third one, which has absolutely the same equal amount of volume of trading as NASDAQ and NYSE. So you can see them, they are green ones. This green sign, it's called BATS, and they are all over the world. That is the first global exchange which operates in US and has 1/3 of the global US market share. It actively penetrates Europe and already has around 15 to 20% depending on the market trading share in there. It actively forces the entrance to the Australian and Brazilian market, and it is held behind with the regulatory reasons. It's also already in Asia. We ourselves, as Moscow Exchange, facing competition from them because they're trading part of the Russian assets in the, on the European trading venues. So that's one strategy. Actually, the Singapore guys, the SGX, are following absolutely the same, but in a bit different way. These guys, they're kind of building the exchange which are interconnected between them, but the SGX is trying to concentrate and trying to trade all the different types of assets available in the world based on the Singapore. Why they're doing that? That's very simple. Singapore is the second, currently the total assets under management which are booked in Singapore are effectively 2/3 of the global West. They're going to become the largest. Currently, they're 2/3 of the other major centers, and they're likely to become the largest center there. So the Singapore Exchange is doing very simple thing. Because due to the tax reasons, it is more convenient for European US money to book in Singapore. They've built an exchange close to that and say, well, come on, guys, it is much more convenient to trade in here. Why do you need to link somewhere else? That's the aggressive strategies, and that's guys are dumping in terms of the cost of infrastructure. They have one of the most up-to-date infrastructure, and the older guys need to compete. There is another model which is about partnerships, which is largely employed by CME and Deutsche Börse, the two largest derivatives players in the world. And there is like the model which ICE another large derivative pioneer is following. They are going through the merger and acquisitions. They're the largest player left in there. But practically, what it means for the world? The trading is global, the competition in trading is global, and the competition drives the cost of infrastructure down. It's practically the same for us. I mean, you are all aware, I believe, that we are facing, as Moscow Exchange, a pretty long-lasting, fierce competition from London. We've been almost for the last, I believe, 7 years, all the times near 50 to 50% split of liquidity. And the thing going there is, yeah, we also, as we have, one of the fields where the competition is going is the cost of our infrastructure. So some people think it's cheaper to trade in Moscow, some people think it's cheaper to trade in London. It depends on a lot of factors. And we're always going around that, and it's inevitable for us as the infrastructure of this country. We need to be an effective infrastructure. If we do not succeed in that, then it is most likely we will lose the global competition. Second trend, which is, I believe, one of the major things which happened to the financial infrastructure since 2008, is the central counterparty's role. So effectively now the key risk bearers all around the world are the central counterparties. If you look into the left chart down, you can see this is the volumes of the OTC trades cleared through the CCPs globally. Back in 2007, it was just 17%. Last year, it was already 90% of trades. So the risk, settlement risk, for 90% of trade is concentrated in the clearing houses. It is no longer banks who are doing that business. It's actually the same in Russia. Luckily, most of our markets are traded in CCP already for a long time. However, the development I wanted to show you is it is the product called repo, and there is a new product which was launched just in 2013, which is repo with CCP. Not going too much into details, this allows the risk switch between the participants. So what happens? If two banks want to trade, like 5 years ago, 3 years ago, they would likely do a bilateral trade. They would like phone each other, agree the price, and do the bilateral trade. Sometimes it was settled through Moscow Exchange, sometimes not. If you look what happened in the just last 2 years, already almost 20% of the repo market goes through the CCP. It is a clear risk intermediation. So people don't want to take risk. They don't even want the risk management departments to evaluate risk on each other. They are rather going to use the CCPs to settle the trade and to clear the trades because they think it is more protective. Okay, one of there are two ideas from that. First, the risk transfer is happening, so the CCPs are becoming probably the cornerstone of each financial infrastructure globally. Secondly, of course, they're going to be the key risk bearers. So if you are looking where the next 2008 or some other crisis is likely to start, it will start when some of the largest global CCPs will blow up. And I believe that the probability of that happening is quite low. However, you never expect that 2008 will happen as well, so we'll see. Another important thing, the market structure changes. Before that, like 5 years ago, the intermediary's role was great. In major OTC markets, the banks were doing the markets, but I'll speak about that a little bit later. And the intermediaries, you couldn't access the market as a buy side. You always needed your brokers to do that. What is happening globally? All the buy sides want to trade directly between them. Moreover, they don't want the brokers to stand between them. What they're looking for, the large buy sides globally, they're looking for a venue where the buy side will trade with buy side only through CCP, and that's it. They don't need intermediaries in the markets any longer. On the other hand, the sell side understands that pretty clearly. So on one hand, they're trying to move away to kind of an agency model. On the other hand, they are still trying to provide credit support to medium participants, and still, if you look into the largest market, this is still the case for the largest market. Even the large US buy side currently building their own exchanges, because if they go to NICE, NASDAQ, or BATS, they need an intermediary who will provide or guarantee the quality of their risk. So, but I mean, if you look into 5, 10 20 years, I believe the most likely thing has happened that the buy side will become the exchanges members themselves. There will be no intermediation for the largest investors required. The same thing actually happens in Russia. Unfortunately, I can't give the statistics on here, on that and here, but practically, probably some of you know, some of you trade, probably some of you trade at the largest desks and you know whom you're trading with. Practically, if you look at Rosneft, Rosneft doesn't any longer has their own, doesn't use banks to trade. For instance, for FX, they're one of the largest owned trading desks which are trading FX directly on the exchange. That's already started in Russia. It is not that far in Russia as compared to other world, but this is where the markets are going. Like the buy side, the corporates will try to develop the markets in a manner when they can trade directly to each other without the intermediaries facing them. Why did it happen? One of the most important changes to the market structure which happened in the last 10 years, actually since 2005, was the emergence of the HFT trading. So the HFT are the guys who are low latency. They do trades in the microseconds. They have these quant strategies which are always calculating what's going in the market and trying to find the arbitrage. So effectively, these strategies, these guys who are running these shops, they've pushed out all the majority banks out of the business. So if you look how the market's changed fundamentally over the last 10 years, it's very simple. Before that, it was the banks who were doing the markets. If you wanted to do a trade, especially the large size, you found a bank. Now, in the most markets where the product is standardized, it is high-frequency traders who are doing the market making. And that's the thing you cannot avoid, because the market making itself changed in its essence. It is no longer a people business. It is the quant machine business, which are evaluating the market and evaluating the bid and offer they can quote to the market participants much quicker than the people do. And you can see kind of proof in that. The share of high-frequency, low-latency traders around the market, it's 50% in the US, 60% in Japan, a little bit low in Europe. On the right part of the slide is figures for Moscow Exchange along different markets. So one thing is the HFT trading is going to exist because this is the modern market making. The modern market making is done by the low latency, high frequency trading firm who are providing you the quotes. If you do not have the infrastructure for these kind of things, you're going to lose because you will not be able to generate new liquidity from these type of providers. Secondly, the good news, well, as we started our platform just 20 years ago, and actually in 1998, we introduced the platform which will allow these kind of things. So as you can see in our markets, like 50% of liquidity is already generated by these newly emerged type of participants. And it's rather that this share will be pretty constant. Because you do not need, it cannot be that, it cannot happen this way that more than 50% of the market is the liquidity providers, because they need to match against someone. But the 50% is kind of a fair share. And the last, probably the most important thing, the OTC market are going to standardize. If you think of the derivatives market back 20 years, it was primarily OTC. It was a huge deal to find the derivatives to trade against. Then the first derivative trading venue emerged. Now if you look at the derivatives across all over the world, it is, depending on the market, it's from 30 to 90% of derivatives is traded electronically and cleared electronically. The same goes, the same is true for the other markets. Like the core OTC markets in the world are bonds and FX. They were the OTC markets like 5 years ago. Now everybody around the world is trying to find the way how to put these markets into electronic trading format. It doesn't mean that it needs to be a central limit or a book. Not all the electronic trading models are suitable for each type of the asset, for different models are suitable for different type of the assets. But it is certainly going to be an electronic trading. And the good thing here, if we talk, like, look how this trend is in Russia, actually it happened so for different historical reasons that here we stand a little bit ahead of the rest of the world, because already 90% of bond trading and almost more than half of all, if you look at the statistics of the first quarter, is already more than half of FX trading is done electronically on Moscow. So while on Moscow Exchange, so while the other people are trying to concentrate this liquidity, I mean, like the CMEs and the BETs, they're being their own FX trading platforms. We already developed this market and we developed liquidity in it. So from this perspective, these market shares globally and in Russia as well, it's unlikely to grow. So the OTC markets are going away. They will be replaced by one or other form of the organized electronic traded market. And that will have a very clear impact on all the market participants, how they are doing business. And I hope that I managed to explain all the key things, how the banks, brokers, investors around the world are changing their behavior. And I believe everything of that is applicable to Russia. That's it. Thank you. Any questions?
Do we have an extra mic?
Thank you for Thank you for the speech. It was quite interesting to hear from somebody from a stock exchange talk about disintermediation. It's putting very, let's say, straight. It's like, okay, the intermediaries like stock exchanges are going to disappear. I mean, very blunt. So what is your strategic response from Moscow Stock Exchange to not to lose or to survive in this global fight?
Well, I mean, if it actually has to do to part of, so one thing regarding this trade comment, I'm not going to say they're going to disappear overnight. I'm saying that globally the market structure is changing and it seems inevitable. Like if the people will try to continue doing business the old way, they will not succeed. That's basically the global trend. Secondly, in terms of at least what is our answer to facing the global competition? The trick is pretty straightforward. What we are historically lucky about is the fact that we are trading all the types of Russian assets on exchange. So we have both OTC and classical spot markets trading in one place. If we come back to the first thesis regarding the cost of infrastructure, if we manage to succeed that our infrastructure is more cost effective than the competitors, we have a chance to survive the competition. How we're going to achieve that practically? If you look at what makes the cost of infrastructure, there are three major things. One is directly the commission, the exchange charges. Second one is the cost of funding. And third one is the spread, what you're going to get on the size when you go into the order book. So what we are practically doing, we are working heavily to decrease the second component, which is the most expensive part of trading on our infrastructure, is the cost of funding. So like the key strategic project which we are currently having is building a collateral and clearing system which will unify across all markets and will allow risk nettings between different types of assets, which will create first type of efficiency. And secondly is improving the collateral types we accept. So basically we understand that if we will not do that, we will continue to be very expensive in terms of this part of our this segment of our cost base. So that's our plan for the next 5 years, if we speaking about this period. We're going to improve the infrastructure by this and improve the collateral efficiency for our market participants, which is likely to create greater liquidity, which is going to compensate for the respective, like it is clear if we decrease the cost of infrastructure, it is going to result in some loss of revenues compared to our current state if like we stand flat. So in order to compensate for that, we're going to grow all our markets. Because if you look in all our markets, they're significantly underdeveloped compared to any like major international things. So we have a really large space to develop the liquidity in there.
Thank you, Anton. A question? Yes.
Thank you, Anton, for your presentation. I have just a couple of questions about these high-frequency traders. The numbers you were showing, it's in percentage of real trading or in orders?
Sorry?
With their share you were showing presentation, is it in terms of real trading happening or in terms of orders?
No.
How much they are in terms of orders?
In terms of orders, they're much greater, like 95, 99% of orders come into the systems from the HFT.
Are you happy with it as stock exchange?
Yep. It's like the thing you need to face in the current markets. You need to provide the proper infrastructure which handles this like pressure on your systems, and we have pretty significant space in terms of capacity internally to handle. So we're not at our top even close. We have like 3 times how called productivity reserve, so we can like grow the number of orders we proceed by 3 times easily on the current systems.
Any guess how much profit they make on MOEX, high frequency guys?
Sorry?
Any guess what would be profit of high frequency guys on MOEX? How much they make per year on MOEX? Any educated guess?
I believe that as I don't know exactly the figure for any specific firm. I mean, some guys in the market speak different figures, but as a good indication of the profitability of the Russian market is that despite the fact that the infrastructure is not totally there, so like the I don't know, the Knights and Citadels are not yet connected, like the I would say 3 of the top 10 US shops are already in Moscow, despite the fact they don't have a US bank which is providing proper risk provision to them. The margins are so lucrative for them that they are taking the high risk of infrastructure which is currently perceived. So based on that, I believe the return is greater than what they can do in US.
Okay, thank you.
My historical view on this is these guys are evil. They're taking money away from our clients, but they are providing liquidity, and if there's an opportunity, there will be more competition that will reduce their margins. But thank you, Anton. The exchange is essential, of course, for all of what we do, but all of what we do ourselves is or should be to the benefit of our clients.